Understanding the process of refinancing can be quite dizzying. Homeowners who are considering refinancing might initially be overwhelmed by the number of options available to them. This video will discuss some of the options available to those interested in refinancing, as well as some of the important factors to consider in order to determine whether or not refinancing is worthwhile. Homeowners have quite a few options available to them when they are considering the possibility of refinancing their home. The most significant decision is the type of loan they will choose: fixed-rate mortgages and adjustable-rate mortgages. These are the two main types of mortgages the homeowners will likely encounter. Additionally, there are hybrid loan options available. As the name implies, a fixed-rate mortgage is one in which the interest rate remains constant throughout the duration of the loan period. This is an especially favorable type of loan when the homeowner has credit which is sufficient enough to lock in a low interest rate. Adjustable-rate mortgages are mortgages where the interest rate varies during the course of the loan period. The interest rate is usually tied to an index such as the prime index and is subject to rises and falls in accordance with this index. This is considered a riskier type of loan and is therefore often offered to homeowners who have less favorable credit scores. Although adjustable-rate mortgages are considered somewhat risky, there is usually a certain degree of protection written into the loan agreement. This may come in the form of a clause which limits the amount the interest rate can increase in terms of percentage points over a fixed period of time. This can protect the homeowner from sharp increases in the interest rates which would otherwise considerably raise the amount of their monthly payments. Hybrid loans are mortgages which combine a fixed element with an adjustable element. An example of this type of loan is a situation where the lender may offer a fixed interest rate for the first 5 years of the loan and a variable interest rate for the remainder of the loan. Lenders typically offer a lower introductory interest rate for the fixed period to make the mortgage seem more enticing. You must consider the closing costs. The closing costs associated with refinancing should be carefully considered when deciding whether or not to refinance the home. This is significant because when homeowners refinance their home, they are often subject to many of the same closing costs as when they originally purchased the home. These costs may include, but are not limited to, appraisal fees, application fees, loan origination fees, and a host of other expenses. These costs can be quite significant. When deciding whether or not to refinance, the overall savings is one factor the homeowners should carefully consider. This is important because refinancing is typically not considered worthwhile unless it results in a financial savings. Although some homeowners refinance to lower monthly costs and are not concerned with the overall picture, most homeowners consider whether or not they will be saving money by refinancing in the long run. The amount of money the homeowner will save when refinancing is largely dependent on the new interest rate in relation to the old interest rate. Other factors come into play, such as the remaining balance of the existing loan as well as the amount of time the homeowner intends to stay in the home before selling the property.